What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 6th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about 3 critical macro charts that start to give us an understanding as to whether or not Bitcoin is finally in a position that it can start to turn into an uptrend, or if it's going to continue on the trotting path downward to new lows and continue the bear market. We need to understand fundamentally through these charts what drives bull markets and why these are so important. If you happen to enjoy the video, consider dropping a like and stay tuned till later, as there's going to be a token airdrop for one of our favorite protocols in the cryptocurrency space. So let's go ahead and kick things off. Now, I want to go ahead and just emphasize here the Bitcoin price, what we've seen over the past couple of days. As we have had a bump up here, I know I've had a lot of people saying, Nick, are you upset that you missed the dip? Did you miss the lows? Are you feeling the FOMO now? Well, I got to be honest with you all, when I'm looking at the chart here logarithmically, the momentum is relatively weak. It's been like this for multiple months. And the reason why is because, if anything, there's only really bid side support. And once that bid side support gets cleared, then we roll over to new lows. There's not that market order flow. We've emphasized that a lot on the channel. And you can see that reflected to a large degree in price. In fact, we may be getting weighed down yet again by the general downward trend line that we've been continuously shot down by each and every time, except for the deviation we had in October and November. And I wouldn't be surprised if we get a little pop up higher, right? A little short-term bump. There's nothing wrong with that happening. But I do think we are going to continue the same trend we have been in, and we are not going to fight that trend, which is the continued move lower. And there's a big reason for this. There's a big reason why in the broader equity measurements, if you take a look at ETFs, which I think actually hold a lot of value here, like the Vanguard Total Stock Market ETF, VTI, gives a really good broad weight of the broader stock market from more the high risk indices as well as the low risk ones like the Dow Jones. And what we see across the board is that we're still setting in likely a lower high, as we've been following lower highs and lower lows. And there's a reason why I think every single time we come up to this 200-day moving average pocket that we're getting knocked down. Let's go ahead and talk about the 3 critical charts that I think are going to give some of that context. First off, we need to talk a little bit about not so much a chart, but an important data point, which is rapid wage growth. Now, I want to be very clear here, because this is something that for some people can be a bit personal, right? Like, put aside, whether or not we agree on, the market going up or down. A lot of people would be a bit kind of off-put by this idea that market experts or market investors are worried about increasing wage growth. I want to be very clear with you guys. I love seeing wages grow. I want to definitely see people do better. I want to see wealth inequality go down to a much larger degree. Trust me, I'm very, I don't know if you want to say progressive in that case. I'm very much in line with the idea that I would love to see a more balanced equilibrium. I'd love to see a healthier middle class. But the important dynamic that I think gets lost in the headlines when it comes to these wage increases in the economy is that they're increasing for the wrong reasons. It's a very important thing to understand that all wage increases are not equal. And that a lot of people, while they are championing and celebrating 5, 6, 7% increases year over year, and salaries, while that definitely is necessary for what's going on, we need to understand why they're increasing. They're increasing because of the excess money in the system and the excess inflation. And the problem is that if we don't have a period of stagflation and a recession, a downturn, where a lot of this excess money stops entering into the system, it's going to continue. Anytime you see wage increases, you're going to see equitable amounts of inflation. You're going to see continued consumer confidence, consumer spending in the economy. And unfortunately, that just propagates inflation even more. It showcases right now, whether we like it or not, that we've got an imbalance between demand and supply. There's too much demand per supply. And when you add in not only excess money through stimulus, through Federal Reserve monetary policy, as well as a broken supply chain system that is not going to get better anytime soon. It's going to take years to get to where we're going, which is a much more distributed, or more specifically, more localized supply chain system that doesn't heavily rely on the globalized structure of China that we've been running on over the last decade and perfecting to a T. We are now going to see continued inflation if we do not see wage growth start to decline, if we do not see the labor market cooling. And we've taken a look at a lot of the charts, and I think one that's very important to look at, I'm going to go ahead and I actually didn't have it pulled up, but I want to show it here, is the total overall job openings on the market. Let's go ahead and pull this up on the screen. Now, you all might remember back a couple months ago, we brought up this chart, and while yes, we are starting to see a decline from the peak at around 11.8 million, we are still at 10.3 million job openings. A lot of companies still hiring, still setting aside that capital for operations to hire new people at better wages, more cost. This is not only an early stage sign of the declining margins for corporate earnings, which is going to lead stocks to go lower, but on top of that, it shows us that the labor market here is still way too overinflated. We have never had this many job openings throughout the entire history of the United States. And it is to such a degree here, over about 4 million to 3 million more jobs than we had in 2019, roughly speaking. We've got a long way to go. If we can look at 2020, if we look at 2008, during the dot-com bubble, we can see there's much more decline to come before the Fed can really start to ease monetary policy. They're going to have to continue tightening. They're going to have to continue to get these businesses to slow some of those operations down. Next up, just wanted to showcase the inflation here. Again, this is why we're starting to see this play out here. But there's another thing that we've got to focus on, something we don't talk about all the time. And it's something that, to be honest, I think goes over the head of a lot of us. It went over my head for a long period of time. The only thing I've got on my side is time here. I'm no expert at the end of the day. I'm just like anyone else. But I've had well over a decade here, pressing around 11, 12 years, studying financial markets. And one of those things that was a lot of relevancy is the bond markets, specifically U.S. bonds or treasury notes. And what we can find with bonds, these IOUs or forms of government debt, is that they not only have obviously the price to them, but on top of that, they've got the yield. And the yields can tell us a lot about market sentiment. Now, you've probably heard in the headlines about a yield curve inversion. Simply put, there are different maturity dates on these forms of government debt, or these treasury notes. And we tend to find that in a healthy economy, the shorter term bonds or treasuries are going to pay a lower yield than those that are more long term. You're locking up your capital or committing to debt that's going to be settled at a much later date. Well, you might as well be getting paid more for it, right? Well, what we find during early signs or warning signs of recession and further downturn is a yield curve inversion. And that's exactly what we're seeing now, where the shorter term maturity from 1 month to 1 year are all paying more yield than the 30-year yield. That is an incredibly telling sign. And if we take a look back through history, this inversion between major ones like the 10 to 1 year spread or the more popularized 10 to 2 year spread showcases that we are at a level we have not seen since the 1970s and the 1980s, back during the last inflationary wave, which remained in that range for a long period of time and weighed down equities with it. So again, got to think about it here. How long are we going to remain in this range? We're certainly much further than where we were here in the 2000s, back during 2006, 2007, before the 2008 recession. I would want to start seeing this shoot up before I'd start getting long on equities, because we can see that there is a leading effect here, right? This lets us know anywhere from a year to 2 years out, sometimes a couple months, when a recession is going to happen. So if we're still declining here, right, this likely means that we haven't felt the pain. It's like here in 2018, early 2019, it's like in 2006, right? We can start to see these indicators declining much more earlier. We want to see this actually shooting up. And I would say a target range of around 2.5% on the 10-year, 2-year spread is where I'm going to start getting really interested. That's where I'm going to potentially be buying the dip, right? That's where the trend can start to reverse. This, I know, seems very boring, guys, but I have to tell you all, if you are here right now, you are at the right place. A lot of people are just going with their gut feeling. This metric is incredibly important. The consistency of this indicator, the 10 to 2 year spread, is incredibly significant. Every single time speaking, when we go through one of these events where the yield curve is inverted, that is a telltale sign that we are essentially going into a recession. Case in point. And maybe history doesn't repeat, but so far it has continued to. And the third thing I want to talk about is housing prices. I'm going to keep this relatively short. To be honest, the metrics we have are for somewhere between September and October of 2022. So there's a little bit of a delay, to be completely candid. But even with that delay, I want you to take a look at this chart here. Take a look at the housing market. And I want you to answer whether or not you think, just take some time to look at the chart, whether or not housing prices have capitulated. Bring up the chart one more time. There is nothing more visually clear that there is excess money in the system still than the way the stock market, the housing market is playing out right now. How everyone is buying every dip, leading to there being relief rallies. And when it comes to the housing market, how housing values have barely declined, with mortgage rates at their highest level in over 20-something years. How can Bitcoin be ready to move up with this excess liquidity in the system and the Fed realizing that it needs to tighten because of that inflationary pressure that the money brings? I gotta tell you guys, this is not looking good to me. And again, while a lot of people like to focus in the micro scale of crypto, right, there is a lot of capitulation events going on, things that are gonna weigh down the industry. The macro flows are what matter. Does the Fed have to keep tightening and therefore restrict monetary policy? Or are they going to be in a position where they can ease? I don't think they're there yet. I don't think that the latter is possible just yet. Now, diving more into the microsphere, as you guys know, we have a partner here on the channel, CryptoQuant. If you guys haven't checked them out, you can check out the link down below in the description. It's a free data science tool. I think it's imperative to utilize data science both in traditional markets and in crypto. And one of the charts that, again, still is standing out to me that really I think is a good gauge for the speculation and the quote-unquote dip buying, right, which tends to happen multiple times. It comes in waves during the bull markets. The Korean Premium Index is the rate that people are paying for Bitcoin versus that of other traditional exchanges like Coinbase. And in Korea, there's a big speculation culture. They're much more, in tune with digital assets, and therefore there's a bit of gambling and speculation. And when you see these premiums being paid, unless we're starting to see wide spreads, like when we're in a bull market, right? This was a telltale sign that we were ready to start correcting and possibly setting the top back in 2021. These short-term bumps are usually signs that there's more pain to come. Until we start to see this really maintaining in neutral territory, negative territory, we're not at peak capitulation yet. There is still excess money. People speculating, buying the dip here and there, frivolous amounts of money that they can afford to lose. They're just tossing here and there. The market will rob people of that liquidity. It will extract that liquidity. Smart money will take advantage of that. And that'll be the liquidity that capitulates and sells at a lower price point where they get their bids filled. When they realize prices out of range, where the macro indicators are signaling it's time for a trend reversal. And this is why, again, we constantly talk about the altcoin market here. We've been taking a look at the percentage dominance of Bitcoin, Ethereum, and stablecoin liquidity and talked about how we want to get it up in that 82.5 to 90% range, real capitulation territory. But another way to look at this is just taking a look at the total altcoin market cap minus stablecoin and ETH liquidity. And really we can start to see that while we've declined a good amount, I think we've got a good ways to go here for altcoins. Right now, it is about finding the plays in the market that are offering really exciting value for the next bull run, that are building right now applications that are either reiterating the existing concepts that had some degree of success or building entirely new things. And I wanted to spend some time to actually talk about one of our long-term partners on the channel that's doing this right now. You guys probably remember we've talked about them since as far back as 2018, and that's Energi. Now, if you guys haven't heard about Energi just yet, they're a really exciting, scalable, and governance-based layer 1 protocol owned by the community. The vast majority of the tokens out there were airdropped to a lot of participants. I'm an Energi holder as well. I'm really excited about the project long term. It's one of the few layer 1s that really has me excited. But they have an even more exciting new protocol that they're building that's focused on an area that, to be completely candid, I'm not an absolute expert on, but I think is definitely a market segment that Energi as a blockchain needs to be exposed to. And I think they're doing it better than practically any other network that I've seen out there, or at least one of the best models I've seen. And that's through their NFT platform, GMI, or Gonna Make It. Now, this is focused on fixing a lot of the persistent issues that were continuing to bother me from getting into NFTs during the last bull market. One of the big ones that they focused on is really having a smooth user experience. There's a ton of issues with major platforms like OpenSea and all these platforms. And on top of that, one of the biggest issues that you ran into was security. So, for example, there was, I think in the past year, the statistic was that there was roughly around $100 million worth of NFT hacks. And for the size of the NFT market, that was more than, say, DeFi for the broader altcoin space. So there's a huge security risk here. And that's the really cool thing about GMI being built on Energi, is that they have the Energi defense system, which basically is a team of people that are going out there and fighting crime, helping people to get their NFTs back, even if there are kind of malicious actors. And this just basically keeps malicious actors away from Energy's network and platforms like GMI. On top of that as well, they've got major token incentives for locking up, focusing on the long term. This really takes on a lot of the platforms that were a bit experimental, like LooksRare, which, while I think had some interesting ideas, really didn't think through deeply on the token metrics. This has been a year in the making for GMI. There's also no wash trading. This is perfect. I'm glad that they removed the incentives for this. This is something that people don't know about in the NFT space that really creates a lot of artificiality in the sense of value and volume. So I'm really happy to see that they've thought this through, and the big bonus programs as well. Now, again, just to let you guys know, if you don't know already, Tommy Willpower is the founder of this, and I'm not speaking out of my ass when I say this. Tommy has been around for a long period of time. He's been making videos on crypto for the past 7-8 years. And I've known Tommy since 2018. He's a really nice guy, really well thought out. It's funny, a lot of the concepts he had for Energi, a long time ago wanted to create a crypto network, and like literally Energi is like 95% in line. And he's just such a cool guy. He's traveled the world a lot, knows a lot about financial markets, trades in traditional finance as well. But basically speaking, he has been trying to fix all of the problems in the NFT space. And I think, to be honest, if you need that kind of market exposure towards those who are building exciting things, I'm not saying you need to go out and buy Energi or anything like that. It's something that I want you guys to do your own research on. But I have to tell you all, I'm an Energi holder. I like Energi as a network. And there's some really cool ways where you can just get free exposure here. If you're a holder of Energi, you're going to be able to claim free GMI tokens. So again, this is one of their airdrop campaigns that they have. But on top of that as well, there are other ways to get involved. There's a really solid referral program. Energi did a really great job with this with their previous protocol, Energi Swap, where you can earn fees for life from people you refer to the network through a similar referral framework like you would use with a UTM link to track. And on top of that, there's also the referral program, which is going to give you a lot of interesting ways to be able to earn on top of the network. So again, if you guys want to check it out, feel free to check out the link down below in the description, where you guys can not only claim free tokens as the airdrop goes live, but on top of that as well, be able to engage with the network, see the UI. I think GMI is in a good position considering the range of partners that they're going to be bringing on into the network here out the get-go. And they're fixing a lot of the issues, from being able to lower fees, offer higher degrees of scalability, better security, and an overall better user experience. This has been well overdue for the NFT space. So hats off to Tommy and the team. We'll be doing an interview later on, likely this week or maybe next week, where I sit down and talk with Tommy a little bit more about the platform. But if you guys are interested, check out the link down below in the description for more info. That being said, everyone, again, heading back here to Bitcoin, closing off this conversation, I think that we've still got a ways to go here. I think we need to be patient. We need to wait for those macro signals to kick in. I bet Tommy, ironically enough, would say the same. We've had some good macro conversations before, probably will in the future. But the key thing overall to maintain is patience. Patience is such a virtue in today's world with YouTube Shorts, Instagram Shorts, TikTok. Everyone is so focused on the here and now. I want to buy something. And they've gotten used to the sugar rush of the last 10 years. But we need to realize that the macro sentiment has changed. Liquidity flows have broken. And right now, there is more outflows than there is inflows because of the excess money in the system. People are taking advantage, smart money is taking advantage of that excess inflow from the market. Anyone buying the dip, insiders are selling, taking advantage of it. We need to be on the right side of the trade, not the one that's emotionally buying every single dip and losing more and more money. Anyways, guys, if you enjoyed this video, consider dropping a like, consider subscribing if you haven't already, and join the DataDash family. Check out the links down below if you guys want to check out any of the things we talked about in today's video. But until the next video, have a wonderful rest of your day, everyone. Take care.